Welcome back, focused learners. Let's jump right into it. Today, we've got a really fascinating explainer lined up for you. We're digging into a comprehensive 2026 study out of Vietnam, and honestly, it reads like a real-life financial detective story. Together, we're going to investigate the hidden macroeconomic forces that cause real estate stock bubbles to inflate and, inevitably collapse. So, what actually causes a real estate stock bubble to burst? It's the million dollar, or let's be real, billion-dollar question. In this explainer, we're going to treat economic indicators as our prime suspects in a financial mystery that we are about to solve. Section 1. The scene of the event. Vietnam, 2006 to 2022. Now, to really solve this mystery, the researchers knew they couldn't just glance at broad, overall market indices like so many previous studies did. Doing that leaves a massive research gap. Instead, they went out and gathered a literal mountain of firm-level evidence. And what really caught my attention here is the sheer scale. 972. That is the number of quarterly data observations they analyzed. It's an incredibly robust empirical data set spanning well over a decade and a half. But here's what actually makes that massive data set so special. It was meticulously pulled from just 20 specific publicly listed real estate companies. By zeroing in directly on these 20 individual firms, they made absolutely sure they could catch every little behavioral nuance and variation that earlier, broader studies completely missed. Section 2. Detecting hidden market bubbles. Okay, before we figure out why a bubble bursts, we need a reliable lie detector to prove the speculative pressure was actually there to begin with, right? Enter our primary investigative tool. Now, don't let the acronym intimidate you. The GSADF Trust is basically just a highly advanced mathematical scanner. It combs through the data to pinpoint the exact start and end dates of real estate bubbles by flagging explosive speculative price movements that are statistically way outside the norm. So, what did the scanner find? Well, it found concrete proof that these bubbles were not just a theory. Specific companies like DIG, HDG, and VIC exhibited this explosive speculative behavior with a 99% statistical significance. They were definitively, mathematically in a bubble. But here's the twist. Others, like FLC and VHM, showed no explosive behavior at all. They completely avoided it. It perfectly proves exactly why studying that firm-level data is so absolutely critical. Section 3. The interrogation. Factors that inflate prices. Now for the fun part, the interrogation. The researchers used a fixed effects model, which is basically a highly sophisticated statistical cross-examination to find our guilty suspects. And they found 4 main factors that have a proven positive relationship with speculative stock prices. First up, GDP growth. When the economy is booming, sheer optimism drives prices up. Second, gold prices, which actually tend to move right in tandem with real estate equities. Third is housing materials. When the physical assets needed to build get more expensive, company valuations just skyrocket. And finally, trading value, meaning massive daily injections of liquidity that pump the bubble even larger. Section 4. The interrogation. Factors that burst bubbles. But you know how it goes. What goes up must come down. The researchers found 3 variables that act as massive deflators, completely responsible for popping the bubble. First is the consumer price index. Basically, when everyday living gets too expensive due to inflation, investment capital dries up fast. Second, the refinancing rate. When the central bank steps in with higher interest rates to cool things down, borrowing costs soar and the market starts to choke. And third, and this one might actually surprise you, is trading volume. While high trading value pumps the market up, a panic-driven high volume of individual shares rapidly changing hands brings the stock price crashing right back down. So it's a constant tug of war behind the scenes of the economy. You've got your inflators, like GDP and gold, violently pushing speculative prices higher, and they are constantly fighting against the deflators, like CPI and refinancing rates, which are just dragging the market back down to earth. Understanding this push and pull is the real key to grasping the fundamental forces acting on the market at any given moment. But hey, in every lineup of suspects, there is usually someone who was just in the wrong place at the wrong time. Meet our innocent bystander, the USD to Vietnamese dong exchange rate. Now, you might assume currency fluctuations would heavily impact real estate stocks, right? Well, actually, scratch that. The researchers found that statistically, the exchange rate showed absolutely no significant relationship to the bubble's formation or its collapse. It was literally just watching the chaos unfold from the sidelines. Section 5. The verdict. Why this matters today. Okay, the interrogation is over, but why does any of this matter to us today? Well, by empirically identifying these specific inflators and deflators, we're handed a highly actionable roadmap. For one, it allows for empirical risk assessment. That means investors no longer have to just blindly guess when a bubble is forming. It also empowers proactive regulatory oversight, so central banks know exactly when they need to adjust rates to cool an overheating market. And ultimately, it leads to targeted policies that can maintain stability in rapidly transitioning markets all over the world. Which brings us to a final thought I want to leave you with today. Take a look at your own local economy. Which of these economic suspects, whether it's rising construction costs, inflation, or shifting central bank rates, are inflating or deflating your local real estate market right now? Thank you so much for joining me on this financial whodunit, and as always, keep asking the right questions.